Welcome back to the deep dive. Today, we're cutting through the noise of market headlines. We're going straight to the core mechanics of the financial world. We are decoding the fundamentals, what money actually is, the four main buckets, where that money is stored and grown, and the crucial institution that acts as the anchor for the entire system.
That's right. And for those of you who follow this topic, we're not starting way back with bartering. We're starting with complexity. Modern life, well, it requires a systematic way to manage vast quantities of value, channel surplus capital from savers to borrowers, and crucially, ensure stability. That's really the mission of this deep dive today.
Okay, let's start with that foundational concept then. Money. It's definitely not just cash and coins in your pocket. Our sources detail that for anything to be considered, well, acceptable money in a complex economy, it must perform three essential jobs at the same time.
hmm The first, and probably the most obvious one, is the medium of exchange. It's the universally accepted tool that lets us separate buying from selling. You don't have to find someone who wants your chickens in exchange for their vegetables.
hmm
Money acts as the middleman.
Right. Makes sense. Then there is the unit of account. This is the common denominator, isn't it? Without it, you couldn't value a house against a car or compare services versus oil. Money gives us that standardized metric.
Exactly. And the third function, which leads us directly into our next bit, is the store of value. This is the promise that the wealth you get today can be put aside and, reliably exchanged for things later. And for money to do all these things, it needs certain properties. Like it has to be sufficient in quantity, easily divisible, portable.
And it's important, I think, for you listening to understand the difference between money in a broad sense,
hmm
which includes your current account, your deposit accounts, and legal tender. Legal tender is specifically banknotes and coins that must be accepted if you're settling a debt. But in finance, yeah, the definition of money is much wider.
And that wider definition is evolving quite rapidly, actually. We're talking about the active exploration of the digital pound by the Bank of England.
Right. This is where it gets really interesting, isn't it? The central bank digital currency, or CBDC, the Bank of England and HN Treasury, they have a joint task force. They put out discussion papers back in 2020 and then a consultation paper in early 2023. So this is serious research into money's future.
It is. And there's a key operational distinction here that's worth grasping. Lots of people already have digital money in their bank accounts. We all do, pretty much. But that money currently is a liability of your commercial bank. If you had a digital pound of CBDC, that would be a liability of the central bank itself. Think of it like a digital banknote, essentially.
Ah, okay. So that centralization is the big difference. That's what separates it completely from privately issued cryptocurrency, which, well, the whole point of that is to operate without a central authority. The digital pound idea is the central bank keeping control, keeping oversight over a digital form of sterling, used alongside cash in our normal bank deposits.
Exactly. But let's circle back to that third function of money, the
Sure.
store of value, because this is where the inherent flaw lies, really. It forces people to look elsewhere. The moment inflation starts eating away at your purchasing power, that storage function starts to fail. And realizing that is what drives us directly into talking about assets.
Right. Why just let your money sit there and lose value? Assets are, well, simply things of monetary value owned by a person or a firm. And we tend to group these into four major classes based on shared characteristics. The starting point for almost everyone, the simplest one, is cash.
Yeah, cash is that universal foundation, mostly because of its liquidity and perceived security. It won't lose its nominal value, its face value. 10 pounds is always 10 pounds. It's essential for short-term needs, emergency funds, that sort of thing. And it does earn some interest income.
But, and this is the big strategic trade-off, isn't it? We mentioned inflation. The sources really hammer home how devastating inflation is to cash held long-term. That example, a 50-pound note from 2011 had the buying power of just 39 pounds by 2021. So if you just kept that 50 pounds in cash for a decade, you effectively lost 22% of its real value.
And look at more recent figures. An item costing 100 pounds back in 2014 would cost you 135 pounds in 2024. Your original 100-pound note. It only has about 74 pounders worth of buying power now. This is exactly why cash is generally poor for long-term growth. Interest rates, well, they rarely keep up consistently with inflation.
And when we talk about interest rate risk applying to cash, sometimes people get confused by that. We don't mean the risk of losing the actual pounds and pence. We mean the opportunity cost. If the central bank suddenly hikes rates, your existing savings account is earning less compared to what you could be getting if you move the money. It keeps investors, well, always looking around.
And that movement often leads them to the second asset class. Fixed interest securities, usually called bonds, and also money market instruments,
Yeah.
MMIs. These are fundamentally loan instruments. You're lending your money out.
Okay, so bonds are the longer term ones, like over 5 years,
Yeah.
issued by governments or corporations.
That's generally right, yes. When you buy a bond, you usually know exactly what you're getting up front. You get a fixed rate of interest that's called the coupon, and you get a guaranteed repayment amount, the par value, on a specific date, the redemption date.
So the return is known contractually. That's the appeal.
That's the strategic insight, yes. Unlike shares, where the upside could be huge but isn't guaranteed, with a bond, you're treating that potential unlimited upside for a degree of certainty of income. Now, MMIs, money market instruments, they're the other side of this coin, very short term, up to 12 months. They're cash-based financing tools, things like commercial paper, treasury bills, mainly used by businesses and governments for short-term cash flow.
Are MMIs just like a slightly fancier savings account then?
It's kind of a step up, you could say. They generally offer higher potential returns than standard savings accounts, and they're usually very liquid. But they do carry some risk. Default risk, especially with commercial paper, a company might not be able to pay it back. And they often have minimum initial balance requirements, which tends to keep the average retail investor out.
Okay, that makes sense. So that brings us to the third class, where the whole relationship changes fundamentally. Shares or equities. When you buy a share, you're not lending money, are you? You're providing capital. You're becoming an owner. You actually get a say in how the company's run.
Absolutely. And this is a major strategic difference. Because a share usually never matures, there's no end date like a bond. It's the perfect instrument for financing really long-term company investment and growth. Its value is maintained because there's an active secondary market where people buy and sell shares. And investors are willing to pay for that ownership as long as the company seems profitable and pays, acceptable annual dividends.
Okay, so we've got liquidity with cash, contractual certainty with bonds, and ownership plus long-term growth potential with shares. That leaves the fourth class, property, which covers both residential and commercial.
Right. Property returns come from two main places: the rental income you collect and the potential capital growth of the property increasing in value over time. Residential property, houses and flats, is increasingly seen as an alternative to equities, hasn't it? Especially with the growth of buy-to-let mortgages. It's often perceived as less volatile day-to-day than the stock market.
And commercial property, shops, factories, offices.
Also generally considered less volatile than equities. And a big chunk of the total return usually comes from those steady rent payments.
But this class has some big hurdles for individual investors, doesn't it?
Oh, definitely. It's highly illiquid. Trying to sell a big office block or factory quickly, not easy. And the costs are high. The purchase price, stamp duty, maintenance, management fees, it pretty much rules out anyone but the wealthiest individual investors or funds. Plus, it's very vulnerable to economic downturns. If businesses struggle and tenants leave, your rental income just dries up.
Hold on, if property is so illiquid and expensive, why is it still seen as such a cornerstone of wealth? Even in the sources we looked at, it seems a bit contradictory.
Well, it's partly the stability of that rental income stream, assuming you have good tenants. And it's also seen as a hedge against inflation because it's a tangible, real asset. Its value tends to rise with inflation over the long run. But the key takeaway for you, listening, is really how your own risk appetite shapes your strategy. Someone nearing retirement probably wants liquidity and safety, so they lean towards cash, maybe ISAs, maybe some safer bonds. An entrepreneur willing to take more risk, they might prefer the higher growth potential of shares, someone just wanting stable, predictable income. They might look at bonds or perhaps property if they have the capital.
Okay, so this whole spectrum from super liquid cash to illiquid property, it all needs a stable environment to function properly. And that brings us neatly to the institution overseeing the whole structure, the Bank of England.
Yes, the BBOE. We can trace its roots way back to the London goldsmiths, actually. They were the first bankers, offering safekeeping for gold, then issuing promissory notes, which were effectively early banknotes, making loans against deposits. The Bank of England itself was founded much later, 1694, initially as a private bank to fund the government. It was nationalized in 1946.
And now it's the UK's central bank. Its functions basically keep the whole system ticking over. Let's group them thematically. First, it's kind of day-to-day operational role. It's the issuer of banknotes, making sure there are enough notes in circulation. It's also the banker to the government, holds the government's main account, manages borrowing, deals with surpluses.
Then there's its critical role in the monetary system itself. It acts as the banker to the banks. The big UK commercial banks hold accounts at the BOE to settle transactions between themselves. And crucially, the BBE influences overall money market rates by changing the interest rate it pays on those reserves, which naturally leads into his role as advisor to the government on monetary policy and, of course, setting the UK's base interest rate.
And it has global roles too, like foreign exchange.
Yes, it manages the UK's official reserves of gold and foreign currency on behalf of the Treasury. And finally, perhaps its most crucial stability function, lender of last resort. This power is the ultimate backstop for confidence in this system. If the banking system faces a liquidity crisis, fears of a bank run where everyone wants their money at once, the BOE can step in and provide emergency funds. That maintains public trust and prevents systemic collapse. And that whole overarching stability mandate was really cemented by the 2016 Act, which fully integrated the Prudential Regulation Authority, the PRA, into the bank, gave it more direct supervisory power.
Wow, okay. That was a fantastic deep dive. We started by defining what makes money acceptable, didn't we? And how its main flaw, that susceptibility to inflation, forces investors to look for protection and growth, which led us to the four distinct asset classes: cash, fixed income, bonds and MIs, shares, and property, each offering a very different trade-off between risk, liquidity, and potential return.
And we showed how the Bank of England provides that essential stability and regulatory framework, influencing everything from the interest rate on your savings account right through to the potential future of money with a digital pound.
So, what does this all mean for you listening? Well, it means every financial decision you make, whether it's putting money in a savings account, buying shares, investing in a bond fund, is an active choice. You're placing yourself somewhere on the spectrum of assets, seeking either liquidity or growth or balance. And that whole landscape is constantly being shaped and managed by the central bank's actions.
Yeah, remember that powerful historical data point we mentioned, inflation turning an item costing £100 in 1955 into a theoretical 2,591 today. Yet the sources also gave that as an anecdote. A 14-inch TV cost £70 back in 1955. Inflation adjusted, that's the equivalent of about 1,815 today. Now, given you can buy a vastly superior, much larger TV for, well, a fraction of that cost now, what other factors beyond just monetary policy or inflation might cause today's real prices for some goods to be so dramatically different from that theoretical inflation-adjusted cost? Something to maybe think about. That's the role of technology, globalization, supply chains. Definitely something to mull over until our next deep dive.